This is the third video of 3 videos related to bond basics for the straight line method. This third scenario, you'll notice that our face interest is still 10%, however now the market interest rate is 12%. So the going rate out in the market for similar investments is 12%, whereas we're only offering 10%. In this scenario, the bond would be issued at a discount. So that means we receive less upfront than what we would have to pay back upon retirement. So the first thing we're going to do is figure out the selling price. And similar to case 2, all we did was take the 0.853047 number, which again is just this 88.53%. We leave off the percentage for the presentation of the selling price of the bond. So we'll multiply that by the principal amount of $100,000, and so our actual selling price will be $88,530. This number is based on figuring out the present value with the market interest rate as our discount rate using the contractual face interest rate of 10%, and this video will not cover that, how to calculate that. So our selling price, $88,530. So what we're going to do is we're going to debit our cash for $88,530, and the amount that we have to pay back is $100,000. So that difference that we actually have to pay back, we're going to go ahead and debit discount on bonds, and that difference or discount on bonds payable would be 100 minus the $88,530, so a discount of $11,470. Now the discount on bonds is a contra account. It's a contra liability. So the normal balance would actually be debit since it's offset against the bonds payable account that has a normal balance of credit. So that $11,470 would be the amount that we would post to the discount on bonds, and if we want to decrease it, we would have to actually credit it. So this will be our full entry. Let's see, make it the same format. So this will be our full journal entry on the date of issuance of the bond at a discount. And the next thing is we need to figure out what our adjusting entry will be for the interest. Now the interest amount will actually be the same because our principal is still 100, our interest rate is still 10%, and we're using the face interest, not the market, because we didn't agree to that. We agreed to the face interest, which is our contractual interest rate, and then 6/12, which is half a year, and our simple interest for the 6-month period is $5,000. So when we do our accrual entry, we're going to debit interest expense, and we will credit interest payable for the $5,000. Now, because we are using the straight line method, we need to figure out what portion we're going to allocate to the 6-month period. So what we're going to have to do is take the $11,470, divide that by 20, so $11,470 divided by 20, and we will actually allocate $574 every 6 months to the discount on bonds. And that will make our interest expense actually more than the $5,000, because we got to make up for the fact that we didn't receive the full face amount at the very beginning. So when you have a bond at a discount, your interest expense is actually going to be a little bit more than the actual interest payment. And then on the first, when we actually pay it, again, it will be the amount of the payment, which is $5,000, the same for all 3 cases. And then when we get down to the entry to retire it, which will be, this entry right here will be done 10 years after the date of issuance. Keep in mind that every single payment period, so every 6 months, we allocate $574, we'll keep doing that until eventually we'll get the balance down to 0. And that means that our carrying value this time will actually be the bonds payable minus the discount on bond. So instead of taking the 100,000 and adding it like we did with the premium, we're going to subtract it against that contra account. And since it's now 0, we just debit bonds payable for the full 100,000, and we credit cash for the 100,000 because we have to pay back 100,000 even though we only initially received the 88,530. So that's how the entries will be different for the case 3 when the bonds are issued at a discount. Any questions? Post in the discussion threads.